This is Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. Listen in as we address your retirement concerns and provide insight to help put you on the path to achieving your retirement goals. And now, Retirement Roadmap Radio.
Hey folks, thanks for joining us and welcome back to Retirement Roadmap with Master Plan Retirement Consultants. My name is Evan. With me as always, retirement planner extraordinaire, Mark Fricks.
Well, I got a new title.
That's it. How are you, Mark?
I'm not sure I can say that.
Yeah,
I'm good.
It's on his business card.
Thank you for that. Appreciate that.
Well, folks, tax season is here, and we've certainly felt the scramble searching for those elusive 1099s and trying to uncover any exemptions that can be found. This time of year, folks find themselves looking backwards to report taxable events and earnings to the IRS. That's become the standard mindset around taxes, always reporting tax history. But rather than looking behind, consider this: looking ahead. Rather than reporting your taxes, plan your taxes. Today, we'll be discussing the difference between reporting your taxes and actually planning for them, and how crucial it is to strategize and have a plan in place for your taxes next year, 5 years from now, even 30 years from now, to fortify your holistic retirement plan. So Mark, what do I mean by looking backwards versus looking forwards?
Well, we're a society where we love instant gratification. Okay, and so and because most retirement accounts going back into the late 70s, early 80s have always been IRA, 401k type of accounts, and so it's a pre-tax situation. And we've gotten very used to saying, hey, put more money into this, I pay less taxes because it less shows up on my income, right? And so I've had CPAs tell my clients sometimes, and our clients, that, Bob, if you'll put another $5,000 in an IRA, I can save you $1,500. And I'm like, you're not saving them that. That's kind of the way the IRS code works. But you're also building up this nest egg, as you know, that eventually is going to be taxed. And as you like to say, and I like to say, there's a mortgage on your IRA or 401k or TSP, it's the taxes due type of thing. So we've gotten very used to that. It's become very easy. A lot of people, I can't tell you how often, and you've seen it too, that we get statements in this office for a Roth, which is an after-tax tool, right? And there'll be $2,000, $3,000 in it. So they were probably listening to a radio show. They said, you should be using a Roth, and it's not automatic like a 401k is. So they put it in for a year or two or three, and then they kind of quit doing it. So it's just a mentality, first of all, the way the system is run up until a couple of years ago. Now that we have Roths in the 401ks, by the way, but you may not have known that, by the way. So the way the system runs, but also because of the way we've been trained, hey, let's enjoy the tax savings this year. We're about taxes later on the big nest egg that you've accumulated.
Yeah, and I think it's helpful to point out the difference between a tax preparer and a tax planner. So a preparer is there to dot the I's, cross the T's, fill in the blank on those reports. The tax planner, however, is there to show you how much you can save and protect you from the IRS, essentially.
Yes, creating a strategy where you can begin, because most people, again, 90% of their retirement accounts are in pre-tax accounts. How do you get it out of there? Well, it takes a strategy. There's several different things you can do. We are experts at that, okay? We do it every day. So how can we get more of that money into those tax-free accounts? The way you need to think about it, we need to think about it from a gross versus net standpoint. So if you go down to Starbucks and you buy a $5 cup of coffee, you're really paying $6.50 for it because you're buying it with after-tax dollars. If taxes go up, you're paying $7.50 for it. And I like to know what's in my pocket versus, what is coming out gross. And so we have to start changing that mentality, and we try to teach our clients that. So in the meantime, we do spend a lot of time creating strategies of getting more of that money into these after-tax type of accounts. And everybody's different. Everybody wants to be more aggressive. Some people want to be more conservative, but it is an important part of it.
Yeah, and I like that, you've said this before, a lot of times people feel like they are at the mercy of the IRS. Can you gain tax freedom?
Well, get more money out of the hands of the IRS.
Can you legally gain tax freedom?
So are we talking evasion or reduction here?
Efficiency, tax efficiency.
Yes. Yeah, you can. You can. One of the books we give some of our clients actually talks about how to create more of a tax-free income in retirement. The earlier you start, of course, the easier and better it is. But again, most of the people we talk to are 45 and up, a lot of them 55 and up, and they've already created this monster, this big ball of before tax money. And so, what I just got off the phone with a client a few minutes ago, a brand new client, and was talking to them about how the fact that, you've built this big ball of money. We talked about some of the ways of getting it out of there, but you're going to pay the price because you've built so much there. To get it out, you got to pay taxes on it. There's no way around it. As you know, we were having dinner with a client last week, and they'd come across a video that was trying to sell a newsletter or something, and the way the verbiage was coming across was like, I have a secret way of getting money out of an IRA without paying taxes. We watched about 5 minutes of it and figured out, not really. No, what he was saying was you need a strategy, right? And that's exactly what we've been talking about.
And I love that concept too, as far as your income in retirement, be it from a 401k, a giant 401k or IRA or other tax-deferred vehicle. You do have a looming tax-deferred monster. And even on 401k statements, now correct me if I'm wrong, there might be a little snippet or window somewhere on the side that says, did you know that this would produce X amount per month in retirement or whatnot? And even that number is not accounting for the net. And so anything you take out from a qualified plan is going to be taxed at your current rate.
Yeah, actually, I think it was Secure Act 1. It may have been before that, but one recent law that came into being actually is requiring 401k plans and TSP plans and things like that to tell you what this will produce. That's why you're seeing more and more of it. So if you've got $500,000 in a 401k, somewhere in that statement, at least on the end of year statement, it's going to say this could produce an approximate amount of $5,000 a month for life, maybe, perhaps, if it grows right, whatever. But like you said, that's not really $5,000 a month. That's really $5,000 minus whatever your tax bracket is. Well, if you know what your tax bracket is going to be in 5 years, I'd love to know, or 10 years, or 20 years. I think it will be higher. I'm almost sure it will be higher. But yeah, that's the problem. We don't.
Yeah,
we don't know.
I had that conversation a couple years ago. One of our clients, CPA, we were working together to work on some returns or something. I can't remember exactly what, but he got a little attitude with me. He said, why the heck did you guys convert so-and-so and do all this? They're going to pay this in taxes. They're going to have lower taxes in retirement. Why would you possibly, and I actually did say to him, well, are they going to have lower taxes in retirement? I didn't even bring up the fact that a lot of people don't like to bring in less income once they retire. They want to maintain a lifestyle. But exactly as you said, we don't know what taxes are going to do, but we could make a pretty close guess, I think, these days, considering the state of the world, the level of taxation now, and where our brackets are now. They're not going to go any lower.
Yeah, it would be. I don't care if you've got a certain party in power in Congress and everything else. They almost can't afford to go lower. I mean, we got Social Security going broke. It's got to be fixed. A big part of that fix is going to be higher taxes, right? Mm-hmm. Medicare is going broke. Where does that money come from? It's called taxation. 33 trillion in debt. That can't keep growing. Just making the interest payments on that is taking up a large amount of our budget. And so there's got to be some fixes. And I know they talk about, we're going to tax the rich. Well, when you dig down in the numbers, the rich are people making $80,000 and more a year, okay? Congratulations, you may not have known you were rich at $80,000 a year, but apparently you are. And so don't think they're kicking up to the rich. The rich have ways of getting around all this, okay? So it is going to happen. And so if rates go up, as rates go up, and you're on a fixed income, and you don't have any tax-free money coming out, it's going to cut into your lifestyle drastically. But I want to go back to the point about we're going to be in a lower tax bracket. I was taught that in the 80s and 90s when I first got into the.
But it's
still preached by some folks. And so according to statistics, most people are living on 80 to 90% of what they lived on when they were working, okay? most people want to live on 100%, but even 80 or 90% is pretty darn close to what you were making. Plus, you probably lost some deductions, and things of that nature, and you've got inflation kicking in. So all of that, and the fact, like you just said, taxes we know are going to go up in the future. Yeah, they're going to be same or higher bracket. And then, as I think you're going to bring this up later, I'm going to go ahead and bring it up. When you turn 73, you're required to take money out of your IRA. Mm-hmm. Could that put you in a higher tax bracket?
You bet.
Sure could. Sure could. So there you go. We have a few people we need to educate.
Yeah. Well, and with the RMDs, it's not just, okay, now you have to take money out. That percentage grows every year.
That's right.
You mentioned inflation as well. Tax laws change, taxes going up. There's this growing snowball, and we've discussed this before. Retirement income need is kind of like an inverted bell curve. Mm-hmm. So the first few years, maybe a little bit more spending. Maybe you need a little bit more for traveling or whatever.
You're younger, you can get around, you visit grandkids, you travel, you want to see the world. Absolutely.
Things might slow down in the middle. You settle in a little bit more.
75, 85, 90, you start saying, I want to stay home and watch TV, watch the Masters, whatever. Or maybe you can't get around as much as you could health-wise. Yeah, spending goes down. Then what happens?
You've got some medical bills. Those expenses start to rise, and then you keep in mind, none of this stuff happens in a vacuum. You've got the taxes, you've got inflation, you've got your RMDs that you have to take. I mean, there are many more things, and that just chops away at what you actually net.
And don't even mention long-term care if that kicks in. Yeah. I mean, so that's huge expense. My parents are certainly aging a good bit, and they're at the doctor 3 or 4 times a week. One or the other one, and so it's just constantly, whether it be a deductible or an out-of-pocket or some of the newer drugs that are costing $1,000 a month or whatever, it gets out of hand in those later years, and so I think this is a great point, the bell curve, and so maybe a little bit better bracket in the middle, but just because you're spending less doesn't mean you're making less. Mm-hmm. You're still getting the Social Security, you're still getting your pension, you still are required to take money out of your IRA. Okay, so that doesn't necessarily mean your income your tax bracket is going down. Just maybe you're not spending quite as much.
Yeah. So. And without getting too far in the weeds, because we could go off in a bunch of different directions. But when you pull a withdrawal from an IRA or 401k, that is counted towards your income for the year.
Just like the ordinary income.
Does that affect your Social Security that you might be receiving or your Medicare that you might be receiving?
It affects the taxation of Social Security. The higher your income is, the more your Social Security is taxable, but also Medicare Part B. So the more income that you have, which includes IRA money coming out, right now the minimum is about $172 to $175 a month per person for Medicare Part B. You make it a little bit more money, it can go to $250, it can go to $350, it can go as high as $560 a month per person if you have higher income, whether it be because of IRA money or whatever. So there's so many, like you said, we could really crawl down into the weeds and branch off and have 12 shows on this if we wanted to, but it's just all so interreactive that that's why it takes a plan. You really have to have all these things into consideration.
Yeah, so folks, while we're all scared to death, let's take a moment to refer you to our website, masterplanretire.com. There you can schedule your complimentary consultation with Mark. You can actually go directly to his calendar, find a time that works best for you, and that's an opportunity to have a complimentary consultation where you can have a conversation with Mark and discuss your retirement hopes and dreams, and we'll even analyze your retirement for you. And again, this is all complimentary. We'll run a series of reports for you to give yourself a good 10,000-foot view of your own projected retirement. That's masterplanretire.com, or call us at the office 770-980-9262. Okay.
By the way, can we put that phone number into a jingle so people can remember it better?
I can just sing it from now on.
Okay.
It'll extend my warm-up, though, pre-recording. So what do we do? So we've got this big asset or assets that might be tax deferred. Odds are most people do have a tax deferred savings vehicle for retirement, whether it's an IRA, 401k, 403b, whatever. What do we do? We need the income in retirement.
Yeah, and so it comes down to really having a tax plan, and every one of them is different. You got to take into account, again, levels of whether they're taking RMDs or not. How much of their IRA are they living on? Because Social Security is a little bit less taxable than IRA money. So maybe we delay Social Security and use our IRA money first while taxes are still lower.
And why are they lower right now, Mark?
The one big reason is the fact that the Tax Cuts Act of 2017, the only way they could get it through Congress was to say, okay, we'll put an end zone on it. So what they did is they created something called a sunset clause. And so that law reverts back to the old law January 1st of 2026. Based on studies, if they look at the old brackets versus the current brackets, the average American will pay 22% more in taxes, okay? So if you're paying $100,000 now, that's a lot of money. You'd be paying $122,000 at that point, or whatever the math may be.
Which would be a couple of points.
Each bracket's going
bracket.
up 2 to 4%. Yeah, and so if you look at the old brackets versus the new, if you were in the 20% bracket now, maybe the 24% bracket or whatever it may be. And so that's definitely coming unless Congress changes it. I don't see any way Congress in the next 22 months is going to change that. I really don't. There's just not enough bipartisanship. Everybody wants their own thing. They're not going to bend. They're not going to break on any of this kind of stuff. And then who knows, depending on who gets into the White House, what may happen from that standpoint. And so I don't see that changing. So you can count on that. So Evan, as you know, we're doing a lot of converting over the next 20 months while taxes are lower. After that, we just have to see where folks are and where the tax brackets are. Maybe we can convert less. Maybe we use what we call a tax arbitrage, which is, some years you have a little bit lower taxes. Maybe you made less money, capital gains. Maybe you didn't sell that rental house, maybe whatever. And so, or maybe you didn't have to put on that roof and take a bunch of money out of your IRA. So maybe we convert more that year. Next year, maybe you're not higher bracket because of, again, whatever might have happened. So we don't just set it on autopilot. As you know, we meet every year with our clients to determine what's this year's plan as far as, doing conversions, getting money out of those IRAs, things of that nature. Right now, if a client comes to me and says, we want to go to Europe, it's $15,000, we're taking that out of an IRA. Not out of a non-qualified account, because I want to get that money out of there into something else, whether it be into a trip or into another account.
Yeah, and I think timing your withdrawals from the right places, the tax bracket arbitrage is also such a powerful tool for planning, which is why diversity in taxable or tax-free or tax-deferred accounts is still important. There is power in tax-deferred. You do get tax-deferred growth. That is a good thing. But just as you said, if you have more options, depending on the time that you need it, the better.
Yeah, and there are a couple of books out there where these guys have written, and girls have written about how to get a zero tax bracket in retirement. And you can in most cases. But you're going to pay a lot of money in taxes over the next few years getting that conversion done. We're more about the fact of being balanced. I want, if it's a perfect world, I'd want about 40% in a Roth, 40% in IRA tax deferred, and then the other 20% into taxable. Like money markets and growth funds that do create some taxes as they grow, but not killer, more capital gains and interest and dividends. But I do now if I could get 60% in the Roth, I'd be happier. But we do need a balance. And if that money that's taxable, maybe we can kind of shield some of that too. Maybe use some municipal bond funds or portfolios or something that will make it less taxable. So we're looking all across the board, being diversified, making sure there's always liquidity available. And again, somebody calls us up and needs money. It's always a decision based on where they're at tax-wise.
Yeah, and it's different for every client. Some clients we have a handful of clients that are being super aggressive towards minimizing their tax bracket in retirement, but maintaining the income that they need through various vehicles. But it really depends how much you're willing to sacrifice earlier on. Now to benefit you in the future?
Yeah, it's really hard. I mean, even the clients that are being really aggressive, they kind of, the next year they do their taxes, they're like, wow, that's a lot in taxes. And I didn't talk them into doing it all. I mean, these are people that are like, I want to be aggressive, I want to be tax-free. But it hurts. Yeah. It hurts now, but it will never hurt again.
Yeah, and what we're referring to as far as what hurts is specifically if you're converting, you are taxed on that conversion, and that is also a conversion
at today's rate.
At today's rate, and that conversion also counts towards your income. So there's a balancing act there.
Yeah.
You definitely need to give it some attention.
And that's why it's nice to do conversions before age 65, so it won't affect your Medicare Part B. But if you're still working at age 62 or 63, you have other income. The perfect scenario is between the ages of 60 and 65 is to do conversions for people that aren't working, that have already retired. That's why federal workers are very easy to do conversions, because they're able to retire usually between the ages of 56 and 60. And so we've got time, 5 years, where they don't have income coming in from work, and they're not having to worry about Medicare Part B premiums, so we can be a little more aggressive. Again, everyone's different, every type of situation, every retirement's different. I wish I could have a retirement roadmap plan A, B, and C, and say B would be good for you. It would take a whole lot less work, but it would not work.
Yeah. And, we had an interesting conversation with someone who attended, we just recently got back from teaching federal benefits classes in Augusta, Georgia. And one thing that you say in every class is it's what you don't know that is going to get you in trouble. And there's so much to know. People don't realize that Social Security is taxable. And the guy that I'm referring to, he said, wait, didn't I already pay tax on that when I was paying into Social Security?
You did.
That doesn't seem fair. Why is that?
What did I tell him? Ask your congressman.
Yeah, absolutely.
Ask somebody that could do something about it, or vote those people out, or whatever. It's the same thing with what we call the death tax, right? So you've worked all these years, you've paid taxes on the income, you've paid taxes on everything you've done, and then you die, and if your estate's big enough, you owe more taxes.
And another point that you make, that there's always an audible sigh from all over the room, is your pension is taxable.
Mm-hmm. Yep, pensions are between 90 and 100% taxable. So it's so many things that are taxable, and you're just not going to be able to avoid it. And that's why I love the magic of the Roth and Roth type investments. Is you don't get a break going in, but you never pay taxes again on the growth, the money coming out, and there's no required minimum distributions on Roths while you're living. So you're not forced to take money out of that tax-deferred account. They're powerful.
Yeah, and we would say if you're a listener on the younger side, take advantage of that information now, because now is the time to put away as much into a Roth as you are able to do, especially if you have decades of employment or saving ahead of you. That will grow exponentially, and you will thank us in 30 years.
You'll come to my funeral. Yeah. So basically, definitely, because a lot of the younger people haven't reached their optimum income level either. So the tax break of putting money into a pre-tax is not super important. Mm-hmm. And if you get used to it in the beginning, you don't worry about it anyway. If you're not used to getting a tax break on your income, just start off with a Roth in your 401k if they offer it, and most people do now. Then you get used to it, and you move on, and like Evan said, you will be so thankful later on.
Yeah, tax planning has become a larger and larger part in retirement planning overall. It's not just moving accounts around for efficiency in the stock market or efficient income or anything. It's perhaps one of
it's top three.
Yeah, for sure.
It's top three most important parts.
And what do you say? Now it might be that you could lose more to taxes than you could
in the stock market. I really think you could overall during a lifetime.
Yeah. Well, folks, thank you for joining us today. Remember, check out our website, masterplanretire.com, to schedule your complimentary consultation, or call us at the office, 770-980-9262, extension. Oh no, I was about to give you my extension. I'm not giving you my extension. I'm on road a little bit. But I do want to say one thing while we have a little bit of time left. Yeah, extension 2. Yeah. That's not mine. We want to do another Q&A episode. So if you're listening or watching this, email us at info@masterplanretire.com, info@masterplanretire.com. Submit your retirement questions. We'll read them off and answer them in an upcoming episode.
Yep, sounds great. So in the meantime, visit the website, schedule your complimentary consultation. We'll run you the reports. You'll get a much better view of your retirement. Until I see you, though, I want you to remember one thing: plan well and prosper. Take care, everybody.
This was Retirement Roadmap Radio with Mark Fricks of Master Plan Retirement Consultants. To schedule a complimentary consultation, go to masterplanretire.com or call 770-980-9262. Thanks for listening, and remember, plan well and prosper.
All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Advisory services offered through Master Plan Retirement Consultants, a registered investment advisor in the state of Georgia. Mark Fricks and Master Plan Retirement Consultants are not affiliated with or endorsed by the Social Security Administration or any other government agency.